Welcome to the Explainer. Okay, let's dive into this. Because look, the reality of personal finance is it building wealth? That's really just phase one. Keeping it, well, that's where the real traps lie, isn't it? Today, we're walking through a roadmap of the 10 most dangerous financial pitfalls that literally silently destroy net worth. And of course, exactly how we can avoid them.
So, to make sense of all this, we've broken things down into four core pillars. First, investing errors. Two, lifestyle and time. Three, strategic mismanagement. And finally, number four, protecting wealth. Let's get right to it.
All right, starting off with section one, investing errors, specifically overconcentration, overconfidence, and procrastination. And this brilliantly illustrates our very first trap, which is overconcentration. Just think about this. If you had bought Intel stock right at its absolute peak around the year 2000 during the whole dot-com bubble, you know what? You still wouldn't have broken through its all-time highs today. No way, even with all the recent tech rallies. But if you had put that exact same money into the broader S&P 500, your investment would have basically multiplied 5 times over. It's like a giant puzzle, and putting too much faith in a single stock forces you to bet your entire financial future on just one piece. That's why financial advisors generally hammer home this point: you really shouldn't let a single stock exceed 5 to 10% of your total portfolio.
Moving right along from overconcentration, we hit a massive psychological trap: overconfidence, usually from early success. I actually have a friend, a highly concentrated investor, who had this incredible hot streak picking just a few stocks. He felt totally untouchable. So what did he do? He doubled down, concentrated even further, started trading on margin, and eventually, boom, he suffered a 30% portfolio loss in a year when the broader market barely even dipped. Ouch, right? And that brings us to a frankly staggering reality. Statistically, 90 to 95% of day traders lose money over a long period of time. Look, a hot streak in a raging bull market does not make you a financial genius, and letting that overconfidence go completely unchecked, that is a massive, wealth-destroying trap for sure.
Okay, our third investing trap is delaying your retirement savings through sheer, plain old procrastination. Let's put this into perspective. If you save just $1,000 a year and earn, say, a 7% return, the person who starts at age 25 ends up with literally double the money of the person who delays and starts at age 35. I mean, just let that sink in for a second. The cost of waiting a decade literally cuts your end wealth in half. This definitively proves that how early you start matters far, far more than how much you actually earn. It's wild. So, how do we actually fix this? We avoid the delayed saving trap with 4 super actionable steps. Number 1, save more. Number 2, stay out of debt. Number 3, live within your means. Simple enough, right? But pay very, very close attention to step 4. This is the ultimate wealth building rule. If you save 50% of every single future raise you earn, you practically guarantee your net worth will rapidly climb. And the best part? You won't even feel like you're sacrificing your current lifestyle, because you never got used to spending that new money anyway. Moving on to section 2, lifestyle and time pitfalls, mainly looking at creep and overwork. Now, what's really interesting about this slide is this hard data from Goldman Sachs on lifestyle creep. I mean, we totally expect to see 57% of those making under $50,000 a year living paycheck to paycheck, right? That makes sense. But get this. Shockingly, 40% of people making over $500,000 a year report the exact same thing, literally living paycheck to paycheck on $500K. When you increase your expenses perfectly in sync with your rising income just to, show off your money, you build an incredibly expensive life, but you totally fail to build real wealth. Now, the sister trap to lifestyle creep is overworking. As your net worth actually grows, your time exponentially becomes way more valuable than your labor. Consider this math for a second. If you have a $5 million portfolio generating a very conservative 5% return, your money is making $684 of passive income every single day. Literally every day, whether you go to the office or not. At a certain point, you really have to audit your hours and ask yourself, is another grinding work week actually worth it? Or is it just diminishing returns, keeping you from enjoying the life you've literally spent years funding? All right, into section 3, strategic mismanagement. We're talking taxes, debt, and complexity. Look, taxis are likely your single largest expense in life, and not being strategic here is a massive trap that leaves a ton of money right on the table. You absolutely need to avoid missing out on things like tax loss harvesting to offset your gains, or failing to max out sheltered accounts like 401ks or HSAs, and of course, ignoring long-term capital gains rates. But look really closely at holding high dividend stocks in a regular taxable brokerage account. Every single time that dividend hits, you owe taxes on it immediately. Move those bad boys into tax-sheltered accounts so you aren't needlessly handing over a cut to the IRS every quarter.
The next strategic error is being, well, a bit lazy about debt refinancing, particularly with high-interest mortgages. Here is the exact math to avoid this trap. First up, wait for at least a 1% rate drop. Then calculate your monthly savings. And finally, figure out your break-even point. So, for example, if it costs you 10 grand in fees to drop your mortgage rate by 1%, but it saves you $263 a month, you just divide those numbers. It takes exactly 38 months to break even. So it is absolutely crucial to know exactly how long you actually plan to stay in that home before pulling the trigger on a refinance. Now, as your net worth grows, so does the complexity of your financial life, right? You start dealing with real estate partnerships, angel investments, a dozen different bank accounts. It's a lot. In fact, over 82% of higher earners admit they've just pretended to understand major investment decisions involving six-figure sums without actually fully grasping them. So the crucial point is this: financial complexity creates incredibly dangerous blind spots. The more moving pieces you have in the whole shebang, the easier it is to miscalculate your portfolio structure, completely misunderstand hidden risks, or literally just silently bleed out from hidden fees.
Next up, we encounter the illiquidity trap. You've probably heard this called being asset rich but cash poor. Take this really great insight from Ben Carlson. For households with a net worth between $1 and $2 million, 66% of that wealth is entirely illiquid, meaning it's heavily trapped in a primary home or a retirement account. If a massive, life-changing new investment opportunity pops up, or, heaven forbid, a sudden emergency hits, you cannot exactly just liquidate your house in a week. Your wealth looks fantastic on paper, sure, but it is completely inaccessible when you actually need it.
To avoid being completely stuck when cash is suddenly needed, you absolutely must follow this essential rule of thumb. Keep 3 to 6 months of living expenses in liquid cash at all times. Period. And honestly, if you have a high income and you're actively growing your net worth, keeping even a little bit more cash on hand can totally protect you from disaster and allow you to jump on those exciting new opportunities the literal second they arrive.
Okay, moving to our final pillar, section 4, protecting your wealth. Specifically, the underinsured trap. Let's move to and see how this builds into a really interesting question. Why on earth should you call your insurance agent on Valentine's Day? Well, this actually comes from a super quirky but highly effective method used by Graham Stephan. He does an annual asset protection audit every single year on February 14th. Because honestly, what better way to show love for your family than ensuring they and the entire lifestyle you've built together are fully protected from a total catastrophe?
The core logic here is super simple. As your net worth grows, your insurance needs grow identically. Your house is worth more, the belongings inside it are worth more, and frankly, you just have more assets that could be targeted. If you don't update the stated value of your assets with your insurer on a regular basis, you become dangerously underinsured. And this leaves you incredibly vulnerable if you ever face a major lawsuit or a robbery, simply because your coverage will not match what your stuff is actually worth today. You've got to keep it updated. Which brings us to the final and perhaps most important question of all. Which of these 10 wealth-destroying traps are you currently falling into without even realizing it? From overconcentration to lifestyle creep, all the way to being asset-rich and cash poor. Look, building wealth is an incredible achievement. It really is. But keeping it, that takes strategy, it takes humility, and a whole lot of self-awareness. I challenge you to audit your own financial habits immediately. Take a hard, honest look at your roadmap, adjust your strategy, and make absolutely sure your wealth is actually yours to keep. Thank you so much for joining me on this explainer. Keep learning, keep building, and I will see you on the next one.